OPEC Plus just hit pause, but is the oil market about to heat up? OPEC Plus just pulled off a balancing act, meeting expectations with a small oil output hike for December, then surprising markets by pausing production for the first quarter. It's the first break since April and could be a move to guard against oversupply. So is the oil cartel playing it safe or bracing for a slowdown? Naveen is senior oil analyst at Kpler. So Naveen, oil advanced for a fourth day this morning after the meeting. Did that decision to pause catch you off guard?
In a sense, yes. I think at Kpler, we had anticipated that there would be the additional 137,000 barrel hike for December. Nonetheless, we also did expect them to continue unwinding these cuts, this 1.66 million barrel a day layer of cuts throughout the 12-month period. I think that was widely anticipated by the market. So in a sense, yes, this decision did catch us off guard. Nonetheless, it does show that the cartel has been looking at its longer-term strategy, but also acutely looking at balances, seasonal trends, and balancing the fundamentals and their longer-term strategy.
Some comments after the meeting. The UAE Energy Minister says that there's no risk of oversupply. Is that confidence justified, or is OPEC brushing off glut fears?
They are looking to go into the second half of 2026 and 2027 with lower global spare capacity, which allows them to manage supply and manage market prices much more effectively. As a result, I think they're well aware that the path to getting to that end goal results in supply and demand imbalances with greater supply compared to demand. I think at Kpler, we're seeing the Q1 balance over 3 million barrels a day of crude and condensate, 3.4 million barrels to be precise. Nonetheless, one thing that OPEC has also mentioned, and we are also seeing in some of the data, is that refinery runs have surprised to the upside with strong margins, pulling up utilization rates, especially west of Suez. So I think part of it is that there will be a bit of a supply glut, but I think they're looking at the longer term picture. And as I said, balances could surprise and become a bit tighter if refinery runs stay robust.
Some reaction after the meeting saw Morgan Stanley raising its near-term crude forecast. Has this move changed your outlook for prices?
I think one interesting fact is we see with the general oversupply coming into the market, prices in the first quarter touching around $60 per barrel on Brent. So not that much of a downside. And I think the upside is also capped due to the strong technical trading levels we've seen. So taking this into account with the overall supply situation we're seeing going into next year, this hasn't materially changed Kepler's view on near-term and even medium-term pricing.
Let's switch to geopolitics, and Chinese refineries are reportedly shunning Russian oil after new US sanctions. Are we finally seeing sanctions bite into the oil market?
We did see in the short term, Indian and Chinese buyers distance themselves from Russian barrels, primarily to reputational risk or the wider issues that could surmount from this. Nonetheless, much like the sanctions that have been on Russia over the past few years, we don't believe in the sort of medium term this is likely to be that material. We're already seeing Indian buyers find some workarounds to take Russian barrels via intermediaries, even barrels that originate from Rosneft and Lukoil. Kpler data is showing that exports in September and October remained robust. October exports from Russia were 3.7 million barrels per day. Those are some of the highest numbers we've seen since the summer of 2023. So I think that Russian barrels will continue to flow and there will be ways around it. So again, we do believe these sanctions, while they cause short-term disruption, in a very material sense, don't alter the supply and demand picture.
And finally, Naveen, President Trump has threatened possible US military action in Nigeria. That's Africa's top oil producer. Could this risk spill over and unsettle the wider oil market?
It could. There is definitely a threat for this. And I think the market pricing has taken these sort of factors into account with the level of geopolitical risk premium that we see. Nigerian supplies, including crude and condensate, is about 1.6 to 1.7 million barrels per day. So any sort of short-term disruption or shut-in of these barrels would have a material effect on global pricing and global supply. I think one interesting thing to keep in mind is the supply from Nigeria tends to be sort of light sweet crude, potentially easily replaceable with US WTI as well. But nonetheless, I don't think it's in the wider interest of the US or the global market to have some sort of disruption from Nigerian crudes, which would cause a huge inflationary spike to prices. So the market is looking at it as a geopolitical risk for now. But again, with all of these, there's a potential for escalation and de-escalation very quickly. So nothing that material for now, but one to keep an eye out for.
That was Naveen Das from Kpler.